Hey guys, Chris Clothier with REI Nation. Thank you so much for joining me. This is an analysis of 2025 as we look ahead to see what is in store for us as real estate investors. What's the market hold? What's going to happen? And I'll tell you, if I had the magic 8-ball where I could ask that question and get the right answer every time, well, we would all be better off. Unfortunately, I don't have that. But what I do have is 20 plus years of experience in real estate, having started actually closer to 30 years ago as a real estate investor. And the company REI Nation, we started as a brand 22 years ago. We kicked off our journey as a turnkey real estate provider and have gone through so many iterations through the years that our experience kind of brings us to a point where we can look ahead and talk about what we think is going to happen based on our experiences from the past. You know, this is unique in some respects. We haven't been in a market like this in a very long time, but then again, it's not unique. It's real estate, and real estate over time tends to perform the same over and over and over again. You just gotta kind of figure out where we are in the market. So with that, that's what today's video is about, trying to help you understand what 2025 is shaping up to be as a pivotal year for us as real estate investors, and some of the decisions we're going to make, because we think we're setting up for a really, really good future as long-term buy and hold investors. So with that, we'll get started. Okay, so I've been doing a lot of reading. I'm sure that some of you guys do the same thing. I try and consume as much as I can from other people and just see what other, I'm going to use the word expert, and I don't use that word in any sense other than experience. I listen to a lot of experienced investors, and I trust what they have to say. And so I kind of mix a little bit of that. I'll let that inform my own decisions, and with that, I'll share with you. So again, guys, as you know, REI Nation, we focus on the southeastern part of the country. I even have this, our website up here behind me. And you can see the map. That's our homepage. You can see all the cities that we're in. We really concentrate in the southern and the eastern portions of the country, and we do that for a few reasons. Number one, weather. The biggest reason we're in these areas is the lack of major yearly, annual winter costs. So do we have winter storms? Of course. Every once in a while we have ice and snow, that kind of thing, but it's not consistent, and it's not annual, and it's not something that we're going to deal with on a almost weekly basis for months on end. That drives costs up on ownership, not only on the wear and tear to the home, but just on the cost for you and for your resident to upkeep the home. And so, it's not a major factor, but it's big enough for us to say, hey, those are expenses we want to avoid if we can. We also stay off of right at the coastal cities. That's due to salt air. Again, very, very rough on basic systems of homes, and also the upkeep, the wear and tear. So we try and focus, if we can, where the climate is relatively predictable and stable. You're not going to have these huge swings, especially on the winter side where it drives cost up. Number two, it's where people are moving. No matter how we view this, no matter where we're located in the country or world, you might be watching this, people are migrating to the Southeast for a few reasons: jobs, costs, opportunity. The cost of living, the cost of housing, the ability to be able to thrive, not just survive, in southern, eastern cities is higher than other parts of the country. And it's from infrastructure, roads, water, schools, all these different things. It's a newer part of the country where you have more growth, more people moving in, more money to be able to bring up that infrastructure. So we love being in Memphis. We've been there for, moved here in 86, sorry. And, we love this area. We love this city. We think there's still a tremendous amount of growth left in Memphis. It is in many respects, it remains an untapped market as far as labor and job expansion. So some of these other cities have had a lot of growth and a lot of kind of growth on top of each other. I'm talking southern cities in instance, for instance, out Atlanta. difficult to see how Atlanta is going to continue to grow because it's already expanded so much. But you take a city like Memphis, and there is a tremendous amount of potential remaining around it. So we love Memphis. We love Dallas. Dallas, one of the fastest growing metroplexes in America. That's the Dallas-Fort Worth area. You might as well call it one city now because they've literally grown together. Pretty soon, Dallas will be located in Oklahoma, not just in Texas. Don't take me seriously on that. That's more of a kind of a joke. But the reality is that Dallas is massive now, continues this massive growth, big growth in population, growth in jobs, growth in diversity of those jobs, that's what's really, really amazing and driving Dallas. So anyway, we tend to stay in the South for everything I just said. All of those reasons, they remain consistent just about every single market across the southeast part of the country. So we're not going to be moving to parts of the country you don't see us in today. I do not foresee us popping up in Phoenix or Vegas or some of these other hot markets that may be fantastic to invest in. I'm not saying anything negative about those markets. It's not our footprint, not where we're planning to go to today. And we're definitely not going to be going up into the Rust Belt because of the winters. There's plenty of good companies that take care of those parts of the country. It won't be us. So I continue to see a continued growth in these southeast markets. If you are an investor that's already in these markets, look, I think you should be comfortable continuing this year to have a plan to pick up quality assets with high quality management companies along the way. I don't think that there's any reason to stop investing. I continue to see a long-term trend in these markets where anything you buy today, it will be worth more in the future, 7-10 years from now, and you should have zero issue with reliable, consistent occupancy in those particular areas because there's a lot of demand. It's all going to come down to, again, the property you pick and the management you have, but still, I think they're high quality and stable. I would continue to build in those markets if you wanted to. As I just said, rental demand in these areas continues to remain high because growth in the market is high. New house formation continues to be high, but there's no properties for them to move into. More and more people today, they want to own, but if they can't own, the next best option is to rent, but rent quality, not just some piece of junk somewhere. And many don't want to rent apartments. Apartments are doing a great job of offering amenities that attract people, but the reality is that living below or above somebody or having a neighbor that's just literally right on the other side of that wall, it's difficult, and many don't want to do it. They want their own space. And so we continue to see demand for median priced homes, 2 income earning households to be high. And that's what we focus on. That's what we specialize in. And I think that that's the right, it's the right approach and the right, segment of the market to be looking at, especially for you guys as investors. So I think rental demand remains high. Interest rates, man, I wish I could tell you exactly what's going to happen, but I can't. I will tell you that what I see happening, and we'll see if this turns around or not. I don't know that the markets, so we're going to talk about the finance markets. I just don't know that they believe that we're past inflation and moving on to a robust growth and recovery phase yet. I just don't think that they don't believe that. So the finance world thinks that we still have some room to go where there has to be, for lack of a better way to put it, just super simple, there has to be some pain to drive housing down in order to open it up for more people to move in. The reality is that I don't think that's the case, but I don't know that I'm going to change anybody's mind. What I think is happening is you have over 80% of the population has their mortgages today at less than 5%. Over 67% of the mortgages today are below 4%. As long as that's the case and interest rates remain in the 7s, people are not incented to sell their homes at all. So the only homes that are going to come onto the market are those that are older generations that are moving out of their houses, and now they're bringing their properties back to the market as they move to whatever their next stage of life is. Or you have new builds, and there's just, the new builds are priced so high at such a premium that investors or not investors, but new household formations are just not yet able to afford buying that home. And so you're kind of in this cycle where rates are not going to come down until the finance market believes that, hey, the economy is back strong where it needs to be, and now rates are going to come down to stimulate and drive the housing recovery, the housing market, the demand for it. I do think overnight lending rates are going to come down. I think it's going to be easier for us to pay off credit card debt, easier for us to have cars, other type of borrowing, but I just don't know about mortgage prices. Mortgage prices are going to remain pretty high, pretty stiff. Now, for us as investors, that's just a line item cost. If we buy high quality assets that we're going to hold over time, it may cost us more in borrowing costs today, but I still think that's short term, because at some point rates will come down. They're not going to stay high forever. They may be stubborn for a while, but they will come back down. And as they drop, we as investors have the opportunity to refinance the assets that we own, who, as rates come down, the values of those assets, they really start moving up quicker than they're currently appreciating. So we now begin to have a spread. We owe less because someone's been paying it off because I bought it. I was smart enough to get in the market. A resident is paying it off for me. Now, as rates begin to fall and values begin to go up, there's an equity spread. Now I have the option to be able to go in without any dollars out of my pocket and refinance this home at a lower rate, driving my monthly note down. And then now not only is the equity spread bigger, but now the monthly income, the difference between what I bring in and what I have to pay every month, grows as well. So now my accounts that have my real estate, holdings, they go up. Now I have the freedom to be able to pay off equity faster or continue to save for any future events like vacancies and maintenance. For me, that's what I see happening. I don't know when rates will come down, but they will. I just don't think it's going to be short term. Look, I'm going to end it with this, guys. I always say this, and I don't want you to think that I'm just some broken record always saying it, but the reality is this. I bought real estate in 24. I'm going to buy real estate in 25. Sometimes it's commercial and small commercial. Sometimes with my brother and father partners, we buy bigger commercial, but also residential. So I'm going to buy properties this year. I'm going to make some investments this year with partners in other places. That's something I don't normally do, but I'm going to do a couple of partnerships I'm already talking about this year in some single family homes. So I continue to invest in the market. And the biggest reason why is because I'm not doing it short term. There's nothing I'm selling in the immediate, anytime near term. So for me, it's just find the best asset, make sure I've got high quality management, that it's going to be in demand. Like through the management and the way, the location of the asset, it's going to be in demand. Then all I want to do is find a resident that's going to provide every dollar I need to own that house. At some point in the future, I'll make even more money on it when rents go up and I can refinance my costs down. But until then, I just want to make sure I've got the assets today. The longer I hold them, I let time do its thing, what time does, and that is drop down what I owe on it, drive up the value of it, and cause a bigger spread in income. That's really the name of the game. And so for me, I'm never going to stop buying. Now, I may only buy 1 or 2 or 5 or 10, whatever the number is based on the market, but I'm not going to sit there and say, well, right now I'm not going to buy anything. As long as I have a little bit of powder and I've got plenty dry, I'm going to be looking to always be adding. For me, it's cost averaging along the way. The whole time I can look back and say I bought houses 10 years ago, 9 years ago, 8 years ago, 7 years ago, and when I look up to sell it, I've got this expanded, big, diverse portfolio. That's my key for 2025. If you are a real estate investor looking to impact your future and build a high quality portfolio for the future, I just don't see the Southeast as being a bad bet right now. Median priced home, high quality management, want to hold it over time. I think you're going to win if you are looking for those types of assets in 2025. Hope you enjoyed this video. Please share any thoughts, any questions you have with me. Until we get a chance to meet again, we'll see you soon. Take care.